Good morning and welcome to this live Rezco Asset Management webinar. It's great to be streaming to you live from our Port Elizabeth office today. My name's Brian du Plessis. I'm Head of Distribution at Rezco, and I'm joined by our Chief Investment Officer, Rob Spanjaard, in the Port Elizabeth office. And in our Johannesburg office, I'm joined by Sylvester, who's Head of Research and Co-PM. What we really want to share with you today is the role that active asset allocation plays in generating risk-adjusted returns in your clients' portfolios. We live in unprecedented times, and we feel that you have to be in a unit trust that is nimble and flexible and is able to make active asset allocations. So just getting straight into it, well, I think a little bit of house rules first per se. There is the optionality or the ability to ask questions at the bottom of your screen. We really encourage you to do that. We'd like to make this live, obviously, and most interactive as possible. Simon will be manning those, and we will tend to answer those questions for you at the relevant time during the presentation, and also at the end of the presentation, we'll allocate some time to answer your questions. We just wanted to share our suite of funds with you today. We've got funds in various categories. Just starting at the bottom left there, we've got our stable fund, which is obviously Reg 28 in the low equity category, and we've got our two balanced funds in the high equity category, our Rezco Value Trend Fund, which I'm sure a lot of you know, and has a 15-year track record and is the best performing high equity fund in that category over the 15-year time period, and our Rezco Managed Plus Fund. We've also got our General Equity Fund, which is an SA equity building block only. So it's great for building block solutions. And then we have our Global Flexible Fund, which is US dollar denominated, and obviously the feeder fund. So how can you access these funds? That's obviously the big question. We're on all the major platforms. We've got a really good relationship with these platforms. We do have our traditional performance fee classes on there, but we are busy loading the flat fees. And if there is a class or a fund, a Rezco fund that you'd like to access on your preferred platform that's not there, please get in touch with us and we'll do our best to get it on there. Something which we're really proud about is the number of advisors that are invested in our funds. We've got over 3,700 advisors, and what's encouraging to know is not one of them make up more than 2% of our total assets under management. And I think I'd just like to take this opportunity now as well to really thank you for your support through the years. We really appreciate it. Without you, we wouldn't have a business, and we really appreciate your support. The last thing I just want to share with you before I hand over the mic to Rob is this interesting slide which we put together. We often talk about diversification, and we talk about diversification being the only free lunch in investing. So how can you measure diversification per se? Well, a good way to do that is looking at the correlation between two or more funds. And what we've got here is a correlation matrix, and we've got our balanced fund, the Rezco Value Trend Fund, and we've got the three largest balanced funds in the country. Now, the really interesting thing is that these three large funds, which we obviously can't mention because we'll get into a bit of trouble, these three funds make up over half of the 450 billion assets under management invested in the high equity or the balanced space. What is a little bit unnerving is to see that the high correlation between these funds. So obviously a perfect correlation is one, where the two funds will move lockstep together, and you can see a lot of these funds have a correlation of 0.9 to each other, which is extremely high. On the other side of the equation, it's good to see that the Rezco Value Trend Fund has a very low correlation, not only to these three large balanced funds, but also to the All Share Index, which obviously makes it a good diversifier in your clients' portfolios. With that, I'll hand over to Rob to take you through the investment part of our presentation.
Brian, thank you. And thanks to the clients out there. We really just reiterating what Brian said. We really appreciate you being on the call with us. Obviously, we'd love to be able to talk in person, but as we're getting back to work, we're in the office, working hard, thinking about how to get returns for our clients, how to manage your money. So this is a halfway between the two. But we really want to keep it interactive. So if you can put those questions in, we find we get really great questions there. About 250 people registered on this call and another 250 on the later call. So it's really great. The questions are really useful and add a lot of value to the discussion. So we've made that time to do it. And so please send them through. It would be great. So without getting into, it's really interesting investment markets. So we can unpack it a little bit and hopefully add some value to our clients, to the advisors out there who are watching. What do we make of it? What's happening out there? How are funds doing? And what does one do in this environment? And let's try just unpack it a little bit. But obviously what we're trying to do, and it's something which a slide we often bring up, because what we're trying to find these risk-adjusted returns. That's hugely important to us. It's not just about trying to get alpha, very high returns. Yeah, we want those, but it's always got to be in the context of that there's risk control. And so risk-adjusted returns, the intersection of those two circles in the middle, that's what we're aiming for. We've got to try find that because it's, there's one in the investment markets, they give you the money, it can give you the return and it can take it away if you're not really protecting the risk and the downside. So it's at very, very uncertain times. So we've got to be quite alert and sharp on that. And that's we've done over the years reasonably well. That's a long-term track record of value trend fund, 15 years, in excess of 15 years. Actually, with the two blocks that are highlighted, the GFC and the Corona crash environment we're in now, have done well at protecting downside. But the point is we've done well through the bull markets too. And it's very important, long-term working. How do we add value to your clients, protecting your money, making those decisions, and then adding upside. So we actually do quite well in bull markets. It's an important point to note. We're not doomsdays, guys. There's a lot in the presentation where we're saying, look, just you probably want to be careful here, but we're not. There are opportunities that will come down the road. Just briefly, we wanted to introduce some of our team. I think some of you know the team here. We just quickly, the people who the people behind Rezco. Myself there, I won't introduce. Jan Krano is our actuary, he's a qualified actuary, he's our chief technology officer, and he also helps us he drives having better, superior investment technology. Within the group, he runs an affiliate called Alice, which does a lot of machine learning, probably the best team in the country, and certainly really world class on using machine learning techniques to help us find the alpha. Simon, who's also on the call, he's been with us since 2015, my co-PM, head of research. Ron Cape has been with us actually for 15 years. Head of operations, they're running the back office. We have a lot of trade settlement. We've got to make sure there's a lot of regulation. He's got 2 lawyers in his team. It's just make sure with compliance regulation, huge part of what we've got to do. And then Brian heading up the distribution. So it's a team we've been together for quite a while, out there trying to find a good product for our clients. But there's a wider team. There's much more people in the company than us 5. And this is obviously can't go into detail, everyone here, but if you look at the colors here, the red are the investment team. So you can see it's a fairly large investment team. The green are the operations people. Huge amount of ops that we've got to do to keep everything smooth. And the blue are the Brian's distribution team. The guy right at the top, that's Wally Gray. I know a lot of you know him. He retired in 2018. He's still he's non-exec chairman. Within the team who's joined us, there's obviously investing a lot of money in our research. So we feel it's important, invest back in the team because we can get clients better returns. So you're trying to find really sharp graduates, really sharp people, but also pulling in some senior people. So if you see John Williams just below me there, in the top row, John Williams was head of commodity research at Anglo American, based here in Johannesburg, London, with quite a big team reporting to him, knows those commodity markets backwards. So it's great guy to have on our team, joined us at the beginning of the year. And it's this concept of just trying to get across without going through. There's some really, really sharp people there. I'd love to introduce them all. But we want to invest in our team because we think it can really add value to our clients. So another part of what we do, just telling you a bit about who we are at Rezco. We live in a country where there's a lot of pain and suffering. There's a lot of difficulty. So we're part of that community. 20% of the profit of Rezco goes to some NGOs that are doing some spectacular stuff, real community-based, making a difference, agricultural development, workplace readiness. And that's just a couple of the ones we work with, particularly through this COVID time, we're able to push in a bit of aid. It motivates us as a team, as a business. It's not just about money, money, money. So particularly even the younger people in the business, you want to work for a company that's making impact on their society, not just about bucks. Hugely important to us. But obviously we need to have a clear focus where we really add value to our clients. And this slide encapsulated why do we outperform? Why do we think we outperform? And it's quite interesting in the context of the asset manager layout. So you've got that block on the left, small managers. You've got the very large managers on the side, and then you've got people like Rezco in the middle, but with some differences. The smaller managers and the mid-sized managers have got a bigger opportunity set. You've got more shares you can invest in and time to implement your decisions. You can get in and out quickly. If something goes wrong with a company, like say Sasol, you can get out. You don't have to just have to stay in it. But obviously what really small managers lack, they don't have that research team. You've got to have a decent sized research team, particularly like in South Africa, we're finding you have to be doing your own basic research. You can't rely on the sell side research like you used to be able to do 10 years ago. So you've got that research capability. And then the point under that, you need a proven track record. Does your philosophy and process work over time? You know, it's fine if did it just work last year, but so there's some great medium-sized managers that you've got 10, 15-year track records. They've seen a bear market. They've survived. They've done well. They've prospered. Obviously, not everyone, but that's what you need to be able to look at. Do these guys have a clear philosophy and a process that works? And some of the mid-size really do that. We're a bit different to a lot of other mid-sized managers. We do active asset allocation. We really believe it adds value in the South African context. In fact, internationally, it's important to do that. And that's quite different to a lot of other mid-sized managers don't do that. Investment tech is another area where we feel we're very strong. We've got brilliant investment technology, which helps us to just go out there and find those returns. So where are we on the market? This is probably what you're sitting there thinking, where do we go from here? Now this slide, this quote actually from Jamie Dimon, who's, for those who don't know, the chairman of JP Morgan, super savvy, very sharp banker. And it's this thing, it's not a normal recession. The recession's coming down the road. This causes a recession. And we think that kind of hits the nail on the head, what's going on here. So you had this corona crash, everyone locked up, and it's been kind of messy. Has the problem gone away? So as soon as everybody's back in the office, it's back to normal, maybe not so simple. And some of the reasons, if you look at this in the US context, you can see the red line there, you can see personal income. So you had this shutdown, personal income's actually gone up. In fact, the blue line, personal spending, fell first. Personal income shot up because they sent everyone a check in the post. And then spending, the blue line at the bottom, spending improved. But it's masking it. It's not going to get the blue line, the spending is still going to be lower than it was at the start of this year. They'll only get back there the end of next year if everything goes right. So an economy totally dependent on stimulus is a dangerous place to be. So we've had this slide at a couple of presentations where we said, look, we think this is the US market, the most likely thing for the red line, where say there's S&P, we just use that as an example, is going to track these other bear markets because it's a recession. It's recessionary conditions, tough for companies really to make money. And even some of the technology companies, ultimately, they sell to people. If the economy is hurting, it'll drag them down too. So we still think there's a lot of risk of that red line heading down towards the yellow line. South African context, same thing, the red line there, where we are now, you can see it's been rolling over. Highly likely it gets down to the yellow line. But you need to be able to adapt to that. So you'll see, we'll talk later on the funds. Actually, funds have actually done quite well through this process since the last webinar, which I think was in June. We've still actually done quite well, and we'll talk a little bit about that, how we've managed to do it a little bit later in the presentation. So one of the questions we're sitting in terms of equity investment, we think it's very unlikely that a new bull market starts from here. It doesn't seem possible. Now, why do we think that? If you take the US context, that's the S&P is the red line, probably one of the better equity markets. It's actually done better than the European markets. But you can see the price earnings ratios, which is the blue line and the yellow line, forward earnings based on earnings 12 months out, even 18 months out. That's at record levels. The market's record expensive. Now, it could go a bit higher, but it's not dirt cheap as it was if you look there in 2008. 2008, the price earnings ratios were 10%. Interest rates are also at naught. 2008, 2009, that's where you start a bull market. You don't start a bull market at record price earnings levels. If you look in the South African context, now we've stripped out NASPAS. Let's just discuss the thing a little bit. I think it's fairly kind assumption. If you put in NASPAS, the PEs would look a lot higher. The PEs are the blue line. So you can see our market is not super cheap. Excluding NASPAS, so you've got the banks, the local companies, the mining companies. We're not at 2008 levels. We're actually fairly expensive. And we'll unpack a little bit about that late in the presentation. Are local shares really cheap? I know we differ to a lot of what you're hearing out there. Now, and here's one of the problems. This is probably, we think, to some degree, a definitive slide on how this recession plays out. And this is the US banks' willingness to lend or tightening of lending standards. So you can see, and it's small firms, it's large and mid firms, it's consumer credit. It's got the range. The picture looks pretty similar. They're just cutting. Banks are, and even the amount that's like dropped in the last quarter. Banks in the US are just, they don't want to give you a loan. Banks in Europe, they don't want to give you a loan. I've got a slide later, same problem in South Africa. So we're in an environment where bank lending conditions are still hardening. It's hard for the economy to turn around. And you can see here, that's it. Same thing, bank lending. And now we've got that, it's hard down red. You can see if you focus on the middle on 2008, so blue line's the stock market. The lending's almost got to free up before the market can recover. So with lending, banks very unwilling to lend to anybody. It's very hard to start a bull market from there. If you look in South Africa, this is a statistic that came out a day or two from the National Credit Regulator. They're measuring it, rejected credit applications. So a lot of the banks gave you a payment holiday, but don't try to get a new loan from them in South Africa. So it's the highest ever, 70% of credit applications are being rejected. Highest ever. If you compare it, cast your eye along there to 2008 along the left there, it's only a small blip up. It went up to about 45%. So it's way, way tough. If you're one of the companies hard hit by Corona and you're going to your bank manager and saying, hey, how about a bit of money? Banks aren't giving you any. And that's very difficult. That's recessionary.
Rob, just to add to that point there, Rob.
Yeah.
I mean,
yeah,
just to make it clear, there's been a lot of talk about can QE save the economy. Now, to some degree, it can plug holes, it can patch up parts of the economy. But what you really need is you need the liquidity of QE. You need the cash to flow through to the end business. And that's why we put these bank lending charts up, because if the banks don't lend the money to the small businesses, if the liquidity from QE doesn't go through to the real economy, do you then recover quickly out of recession? It's very difficult to recover out of recession until the liquidity starts flowing through to businesses. And banks know their customers well. They take the risk. When they lend to a customer or a business, they take the risk of default. And so the banks, knowing their customer well, are saying, we don't want to lend to them just yet. It's too risky. And that's why we're a little bit concerned at how quickly the market's kind of cottoned onto this V-shaped recovery, this quick recovery. Because there's more to recovery than just QE. There's mechanisms within the economy that need to happen, and the liquidity needs to flow through in order for the economy to truly recover within the business space. And similarly, you can see we had the consumer spending charts up. That consumer spending wasn't based on positive sentiments, it was based on free money. Until there's positive sentiments that it can flow through, it's going to be difficult for the economy to truly recover unaided. And that's what you really need for company earnings growth to start compounding and growing from here.
Yeah, so in short, we're saying too early to go diving back in equities. Another area is South African fixed income. Interesting picture here that at Minister Mbowene's interim budget after the corona, the one in June, he presented some numbers. So the blue numbers, is the sort of yellow number at the second from the bottom is what the budget was in February. Then he said, look, we've got two alternatives. You've got the red version, which is if we sort of do nothing, that's where the debt to GDP is going to go as a country. And then the white version, if we get a whole lot of things right, which given on past ability to deliver, and certainly we're always hopeful, but it doesn't seem they're going to hit the white one. At best, they hit somewhere in between, but most likely it's probably the red one. Public servants aren't going to not have a salary increase. Certainly, I hope they agree to skip it. But the problem on that is if you're on the red line, you can see the budget deficit over this year, 2020 to 21, over the next year, you've got almost 600 billion that the government's got to borrow in 1 year. And that's massive. It's tough to do that, especially in the context. This is percentage of our debt owned by foreigners. Foreigners have been selling from down about 45% of our debt, they're down to 30. There's not a lot of appetite at the moment for that. And you can see what's happening locally. So the blue line there's still the foreigners selling off. There's a pinkish line. That's how banks are buying the stuff. Why are the banks buying it? Because it's much easier to take the money and put it in say, R186 with a 5-year term than to lend it to you or me for 5 years. They've got no credit risk. And then there's income funds below that, the greeny sort of line. But that's not, you don't have economic recovery on that. Best the holding pattern, and the quantum of it is too small. Now, foreigners could suddenly change their view of South Africa and get you excited if we really got to be backing President Ramaphosa, that they get this reform right, that there's some rumor that as prominent, involved in the ANC, Stina Dairy case, there was a person called AM, let's call him Arthur Morris, is going to get arrested. He's a prominent ANC politician, apparently. So if Arthur Morris gets arrested, AM, those sort of things, there's proper action, there's reform. Certainly we must be hoping for that. But at the moment, we've learned you need to be a little bit wait and see, but prepare to change your view quite quickly. But there's this massive amount that they have to borrow that is quite difficult to do. One of the questions we get is, some people say, look, our values of our local shares, the SA Inc., let's call them those, they're the cheapest they've ever been. You need to dive in here. We've got some thoughts, and I'm going to let Simon take this one, a bit of detail. We think a lot about it. We're not just some top-down macro view. We're thinking a lot about it. Simon will just share our thoughts a little bit on this.
Thanks, Rob. So there's quite a lot of talk in the industry. Some managers saying they're seeing value in SA Inc., best value they've seen in 5-10 years, and some managers saying it's too early, you don't want to touch SA Inc. So what do I mean when I say SA Inc.? I'm talking about South African banks, South African retailers, South African industrial type shares, basically companies that are linked to the South African economic growth story or lack of growth, potentially, however it comes out. So this chart is a year-to-date performance chart of different sectors, just to kind of get a feel. You can see the blue line there is the index of our local banks, and they are down year-to-date about 40%. So the share prices have really taken a beating through COVID. Part of it's the economy, part of it's interest rates falling is bad for banks' profits. But you can also see some more defensive sectors, consumer services, those are your retailers, largely kind of Fashinis or something like that would be in consumer services. And they've fallen just over 20%. So also they've taken quite a big knock. And food and drug retail, very defensive. That's your Clicks, your Woolworths, and so forth in there. Pretty defensive, and they're only down about 14%. So these shares have taken quite a beating, and that's where a lot of managers are saying, wow, these shares have fallen a lot. There's got to be value. If your bank goes back to where it was, your bank share price goes back to where it was, you're going to make 50, 60, 70% upside from here, and you just need to be patient. Interestingly, mining shares has been the best performing sector, and this index, South African mining shares, up almost 40% year to date. So that's where all the returns have been. But as we know in investing, and on the next slide, share prices aren't share valuations. When you buy a share, you don't pay the price, you pay the valuation. You're buying future earnings, you're buying future cash flows. And what's really interesting, if you look at the red line now, still the mining index, but the PE ratio, the price earnings ratio, you can see that the index that has performed the best year to date has, in this case, sort of PE ratio, the cheapest valuation. And banks have fallen 40%, but their valuation doesn't look that cheap. It's kind of on the low end of its long-term range. And the consumer shares don't look cheap at all. So what's quite interesting here is just because share prices have fallen, it's that interaction with earnings that create the valuation. And as you can see here, it's not all about price. So what I want to do is I just want to dig in a little bit of detail. Hopefully you'll find it useful. I've got 2 case studies. The first case study, Standard Bank. Just to dig into some detail, because a PE chart and a price chart might not give you the detail that you'd need to try and understand this. So let's just use Standard Bank as an example. So you can see Standard Bank's share price from its peak has about halved. Kind of it peaked at about 220 Rand, it's down at about 110 Rand. Okay, so that's a huge share price fall. So the share price is back to where it was in 2010, 2011 type period. But the price earnings ratio in this case, and this is the forward price earnings ratio, so it builds in the expectations of earnings going forward from here. So it doesn't have the big COVID crash, and it's from now going forward, the earnings expectations. That puts the price earnings ratio, the valuation, on 8.8. Not that cheap. I'm not going to get too excited about it. So I said uncertain valuation. It's not convincing that it's so cheap that if you just buy it now and wait 2 years, you're guaranteed to make money. You've just got to be patient. There's more nuances to that. So if I break this down on the next slide a little bit, you can see what's one of the big drivers in a recession for a bank. So the slide's slightly technical. I'll go through it and hopefully it will be useful. So what you've got here on the slide is what calls the credit loss ratios, the gray line. So that's basically a provision for banks losing money because people default on loans. So the bank lends out money on a mortgage and the person loses their job, they default. It's going to come through at some point in time within a credit loss ratio. So more negative is bad, higher or smaller negative is better. And what you can see on the red line is the GDP for South Africa. It's the real GDP, so inflation adjusted, as an index of 100, going back 20 years. And you can see the red line grows nicely, and then in the GFC has a little bit of a dip, and then grows nicely again. You can see the big crack in the GDP towards the end of the line there, and that's the crash from the COVID-induced, the lockdown-induced recession. What's really important as for a bank, as you can see, in a nice economic growth environment where the line's trending upwards, your credit loss ratios are low. And when you have a recession, so the credit loss ratios are a smaller negative, so say 0.4, 0.5%. And then when you have a recession like the GFC, you can see in 2008, 2009, your credit loss ratios get much more negative, so minus 1.6. So it's a really nasty number. GFC did it for 2 years and then recovered. As in this example. So now what's the point I'm trying to make here? Is if you look at what's happened in South Africa, the current recession is substantially worse than the GFC for South Africa. So the GFC, we're building for the World Cup. We came off a much stronger position. The world recovered fairly quickly. China recovered, and all our resources and so forth did nicely on the recovery. And so the impact in South Africa wasn't as big as what we're feeling now. This is substantially worse. But what's interesting, and these are consensus numbers, so kind of average of the view out there, is the market thinks that we're going to have 1 year of credit losses similar to the GFC, and then it immediately recovers. And so the point I'm trying to make is it's a lot more complex than just, well, the share price is halved. There's a big risk that credit losses are a lot worse, where you don't just recover from here. It doesn't just get easy from here and everyone starts repaying their loans as per kind of a normal expectations and everything's being provided for. We think it's a lot more complex coming out of this. Now, if those credit losses stay as similar to GFC levels or even worse than GFC levels, what will happen is earnings for Standard Bank will fall and the PE ratio will actually go higher without the share price going up, i.e. it gets more expensive, but you don't make any money. And that's what you don't want. That's called a value trap, where you buy something that's cheap and it gets more expensive. Either PE goes up because earnings expectations fall, the future expectations get worse than what's expected. And it's that kind of nuance that we think is really important in understanding this. South African Inc. share prices have fallen. And if I break this down a little bit more on the next slide, you can see the whole sector here. I'm sure you've seen in the news, and I'm sure you've had clients that have been experiencing this idea of loan relief. It's pretty unique to the COVID situation, but basically this leniency where you don't have to repay your mortgages, that's the blue, or your vehicle finance, your car loan is the red. And all the banks have been doing it. And what we're showing here is the banks, as a percentage of their total loan books, how much of that loan book is on payment relief, i.e. customers don't have to repay their loans. And you can see that these numbers are substantial. There are a lot of loans that are not receiving monthly or not being paid back with monthly debit orders. And so the risk we see is, well, when you switch it back on, what happens? Do people actually have the money? And as I'm sure you know, within the financial services space, it hasn't just been home loans and car loans. It's been retirement annuities, it's been pension funds, it's been all sorts of leniency on regular contributions. And if you go on to the next slide for Standard Bank, I'm going to stick with the case study of Standard Bank just so we can break it down a bit more. They've got about 600 billion rands worth of personal and business banking loans. So that's the bar on the left. Now, 107 billion have relief, i.e. there's payments holidays, and the rest have no relief, okay? So that's that's 107 billion rands worth of loans at Standard Bank in that division, the personal business banking division. The clients aren't repaying their loans at this stage. They've got holidays, okay? So now you say, well, I was talking about credit losses. What's the chances of someone defaulting? So they've been given a payment holiday. Are they going to default? Now this question, this is why the title here is, we're uncertain about this. This is very kind of, it's unprecedented. I'm not convinced that the valuations are there, and I'll show you why. If you look on the chart on the right, what this is how much coverage, how much does Standard Bank think that the loans are going to default? So what you've got is you've got your different stages in loans. Stage 3 is pretty close to default, already defaulted. Stage 2 is there's a risk of default, and stage 1 is just business as usual type of loans. And what you can see within the numbers, so this is Standard Bank as an example, the expectation for default of clients that have had relief, that's the gray bar on the right-hand side, is lower than clients that have no relief, i.e. they're thinking that there'll be less defaults of clients that are on payment holiday than clients that are not on payment holiday, as far as coverage goes, quite simplistically. Now, we're not saying that they're wrong. There's an argument to say, well, they've had the relief, therefore they're less likely to default. We're not saying they're wrong. What we're saying is it's not as simple as Standard Bank's share price has halved, and buy it, be patient, and you'll make 50, 60% return. This is the cheapest you'll ever buy these good quality banks. We think Standard Bank's a great business, but there's complexity in forecasting the earnings, and we don't think the market's being cautious enough in the valuation here. So I hope that was useful, gives a little bit of a color that we're digging into the detail. On the other hand, what about a mining share that's rallied a lot? SIBANYE, Stillwater, for those of you who don't know, it's a gold and platinum, a platinum miner here in South Africa and in the US. And its share price, you can see the red line, has gone up almost 5 times in the last couple of years. So it's kind of the polar opposite of Standard Bank. Standard Bank's halved. Is it cheap? Well, the other side of the question is a company that's gone up 5 times cheap or expensive? And in this case, you can see the price earnings ratio for price earnings ratio of 4, that's that kind of gold line, is almost at its lowest point in history. It's the cheapest it's ever been, even though the share price has gone up. And why is that? If you look at the blue line, that's what they sell. That's the price of gold and platinum in rands as a basket for what they sell. It's at record highs. It's a great environment for this company. They're doing very well. They're generating a lot of cash. It's as good as it's ever been. And the share price is up a lot, but it's pretty cheap. And so I've just got these 2 examples that the debate's not as simple as I think sometimes is projected out there in the markets of buying shares that have fallen because they're cheap and shares that have gone up a lot are too expensive. There's a lot of hard work we do in the background to really get to grips with what the valuations mean and what is a good risk to take. So on the next slide, You know, we're all about risk-adjusted returns. What's a good risk to take? Is Standard Bank, with all those loans that are on payment holidays, a good risk to take? At the moment, we don't have exposure. We think it's too risky. Yes, it could recover nicely, but we're not too sure that when they ask for the money from all those clients, that they repay as expected. And so we think because of that uncertainty, the risk is high. You might get a high return, or you might lose a lot of money. It might be a value trap at this moment. And I'll hand over back to Rob there.
Oh, thanks, Simon. Yeah, that's so we wouldn't want to give the impression that we've all gone home. We're working really, really hard, and you can find opportunities. There are some opportunities out there, but, you know, reiterating what Simon's saying, you've got to be really careful that you're not buying a value trap. There's some things that look cheap, but sometimes they're cheap because they're cheap for a reason. But in this environment, working hard, having a research team going through a lot of companies, you can start to find opportunities. But we're not going to, because we've got a flexible asset allocation style, we're not going to own stuff because we just have to own them. We'll own companies where there's a great investment case. Otherwise, we're prepared to sit in another asset class like bonds, commodities, or cash. And in doing, you know, we're doing this thing of this, trying to find these risk-adjusted returns, to just mention, you know, we're trying to, how do we measure it? How do you assess, how do we internally assess, and how should you be assessing, is this working? You know, what we think, if we're managing the risk, you should be getting lower correlations, lower volatilities, and lower drawdowns from the equity portion. Then the return measurement, you should be getting the outperformance. So you want both. You want the outperformance, but what do your risk stats look like? And just looking at, in an example, Rezco Value Trend Fund, and it's quite similar for all our balanced funds, our Managed Plus fund, and even our stable fund. It's obviously a lower risk stats because it's a stable fund, but it's a very similar picture. I'll just use Value Trend as an example. So you've got the return on the left there, and then you've got the standard deviation at the bottom. So vertical axis return, standard deviation at the bottom, and you can see, so you want to get that return, but you don't want to be taking a whole lot of risk. At the same time, you don't want to correlate, but you don't want a lot of risk. You don't want to be different, but much more risky. And we often try to take pains to tell clients, no, we're not different because we take some huge positions out there. We tend to be more conservative. So you want to be different, but lower risk stats. We don't go and, like, for example, take huge, we want to put everything in commodity shares or everything in South African incorporated shares. It's a process of risk management. And just, you know, where does it add value? This we think is quite an interesting slide. There's a couple of blocks there. The diamond on the far right, that's a large passive balanced fund, Reg 28 fund. You can see the volatility, which is the bottom axis. It's actually more volatile. Rezco is a dot at the left. So there's more volatility, lower return. Then the blue thing is three really good balanced funds, ones that are large and used a lot. Decent funds, some of them have a place in every portfolio, and I'm pretty sure a lot of people are using them. If you add Rezco, because you can see where the red dot is, this is 3-year numbers, Rezco's return and volatility is much lower. So when you combine Rezco, so that's a third in the blue dots, you move it to 25%, add Rezco to it, you get a noticeable drop in risk stats and an improvement in performance. Because what Brian was saying earlier, we combine really nicely with those funds. And just a punt for active management, all of us do better than you can't passive balance funds. We don't think that works. It seems a great theory, but the active managers are definitely doing a better job on this price, much better risk stats. Certainly from our side, we add value, quite good value with those funds. Interesting one on an equity fund, where that fund has to always be invested, as you know, South African shares only. And this is sort of measuring our equity selection skill. How good are you? We make the macro calls, great. But are you good at doing equity research, finding the companies, avoiding the landmines, finding the good companies? So if you look, there's the equity fund, the 3-year, near the top of the class in return, one of the lowest risk stats. important to do it. The same thing. You keep you want the return high, but you want good return. You want low beta. You want good return and you want low standard deviation. Another way of measuring it is the beta. Now, the beta is how closely does the equity track to the all-share index. So if you've got the all-share index has got a beta of 1. If you got a beta of 1.1, like you can see there's some funds there, 1.1, 1.2, in sort of classic finance theory, yeah, you outperform, but you just took more risk. So you actually didn't really achieve much. In this case, it's got a fairly low beta. So you're being skillful on your equity selection and adding value. It's a good measure of skill. And one of the things just to point out that this is the equity fund since inception, just over 6 years. The equity fund's done about a 60% return. Allsy's done about 45. The equity fund wasn't dependent on Naspers process. Allsy, without Naspers process, it would have just been the red, which is not a pretty picture. Now, that's great. You can have a separate debate about Naspers process, but if all your funds are too heavily dependent on one share, it's tricky. And obviously that translates to our equity exposure.
Rob, we just got a question on, I think the previous slide was about on topic there. Francois de Toy, just asking about, we've been speaking about value and growth, and I had those examples there. And so Francois de Toy just saying, once again, value versus growth comes up, value underperforming growth. What's our view, especially on the lower cost of capital levels? Growth stocks and balance sheets being in the best condition they've ever been, Naspers and Process, the Facebook shares. It's probably worth discussing. We don't have specific slides on it later, so I'm interrupting with this question, Rob. I think it's worth just mentioning. Yeah. Firstly, remember Rezco value trend. Firstly, the value part is valuation, and the trend part is momentum and growth. So we try and find this intersection of good quality growth, and you want to pay the right price for that growth. So that's what we try and do. So we're not kind of at either extreme of pure value or pure growth. We're trying to find the intersection between the two, and that's our style that's worked for us. That being said, this idea of growth shares, especially with low costs of capital, low interest rates, meaning that their future earnings, i.e. the growth is more valuable, because you're discounting at a 0 rate or a 1 or 2% rate. So your growth of earnings in year 5 and year 6 and year 7 is now more important because interest rates are so low. And that's one of the reasons why the growth shares and the tech shares have done very well. On top of that, of course, their business models have become more relevant with the lockdown and people working kind of remotely, and tech's become more important. So we don't think that you have to pick a camp. We think that there's some good growth shares, there's some good tech shares that are opportunities. And then there's some shares that sit more on the value side, which can be good opportunities as well. I don't think that this value versus growth, as represented as these two extreme views, is something that we have to stick to. So that kind of flexibility. So in the equity fund, saying we find a lot of places to get good returns for our clients. It doesn't only have to be Naspers, as an example you've given there, Francois. It doesn't just have to be Naspers. There's other tech shares. There's other tech angles. One of the examples, Discovery as a share has been rallying a lot because the global investors are buying it for their Vitality business. That's a tech business, and the reason it's rallying is not because it's a South African insurer. The reason it's outperformed all its peers is because of its tech. So Naspers isn't the only place to play tech on the JSE. There's other opportunities as well. But yeah, so I don't know if that's helpful in this kind of value versus growth argument. It's always more complicated than that. We've always got to dig underneath and see exactly what's happening. And it's about paying the right price for growth. Growth, when you're paying a price over sales ratio or price over clicks ratio or price over number of users, that starts getting a bit dangerous. But when it's a good quality growth business that's generating cash, you can pay up for that growth. And we are certainly happy to pay for good quality growth within our funds.
Yeah, we're happy to pay up for a good company. But, one of the sayings, we've got a kind of couple of principles in our investment team, is that in the short term, the market teaches you bad habits. So we tend to behaviorally as human beings, we look what worked over the last 6 months, 3 months, and then we change our view. We don't, but there's a temptation to, as behaviorally as human beings, the market wants to teach a bad habit. And what's the bad habit the market's teaching you at the moment, or trying to teach you, is earnings don't matter. Don't even look. In fact, buy companies that don't have, buy companies that are making a loss. The bigger the loss, the better. And yeah, and it's worked. It's worked with Tesla. It's worked with Snowflake. It's worked, you know, Zoom. Great. We're on Zoom. Fantastic. But Zoom's biggest competitors are Apple, Google, Microsoft. You know, you got more, and there's a whole lot of hosts, the smaller ones that you can do webinars on. And no earnings, huge losses. We ultimately, part of our core philosophy is earnings really matter. Yeah, you've got to look a little bit forward. It's forward earnings. What's the forward earnings stream? But just assuming, yeah, somewhere along the line, these guys will make money. That's not a style that we found has worked. And it's a dangerous thing now. Just close your eyes and buy the thing because it's growing. And we think that ends. It's going to, history, we're destined to repeat what happened in the dot-com bubble. That was a problem in the dot-com bubble. It was like you started valuing, and you know, that's a long time ago, 20 years ago, I was sitting there thinking, maybe I'm a dinosaur, because you're looking there and you're thinking, so now you value a company on multiples of clicks. And we're doing that same thing again. For those who are around that time, you're starting to see some distinct similarities. We've got a philosophy, it works, and we're happy to stick to it, and it's working in the current environment. Our fund positioning, you can see that's value trend fund, that's long-term. The red is the risk assets. You can see we prepare to be quite flexible in that asset allocation. At the moment, we don't have a lot of equity or commodities, but we've got a lot of bonds. Not a lot of duration though. That's been working for us. Stable fund, a similar kind of picture. Obviously a much lower risk profiles that we're taking, so it's even lower. And over history, it's a low equity fund, so it doesn't conquer up to 75% invested. It tops out at 40%. But how's this been working for us? Quite important to talking this through with the clients. That's Rezco value trend 3-year performance is the red line. The yellow line is our peer group. So it's nice. It's fund has done well. We managed to miss the corona crash adapt. We had a very good year in 2019. That worked, outperformed nicely, did well that over that corona time. And I'll talk a little bit about later. The last quarter, the fund actually did very, very well as well. It was top decile, but I'll come back to that. Managed Plus, similar picture. We're just looking for these steady risk-adjusted returns, keep adding value to our clients. Stable fund, great. I think there's great place for stable funds in the flexibility that income funds don't always have. Stable funds really done that same profile, just steady, strong returns. Our equity fund obviously had to be fully invested, so you can see it fell slightly less in the all-share index and has gone up more in the rally. So you can see relative to the peers, which is the yellow line. We've actually, through the corona thing, we fell, but we've come out of that gap has widened between us and the peer group. And that's just a lot of research, a lot of work. Our global flexible funds, we're talking about that's been going, that's relative to its peer group is a yellow line. The global flexible fund, it's a Luxembourg fund Brian was talking about. There is the rand denominated version locally. And that's just also solid, trying not to have these big risk drawdowns. So part of what we're trying to add on this side, so obviously you can see on the equity fund, the equity research side really works. It's not just taking big macro calls, but asset allocation on the balanced funds is very, very important. And, that's what we've said, you've got to be flexible and you've got to be nimble. If certain key points, it looks like locally, if I give you an example, South Africa, check one. The big infrastructure program, 1.5 trillion, is going to work, fly. It's executable, it's starting to happen. ANC really starts cleaning up its act. Public sector unions get on board. They're behind the government. They're accepting no pay increases. Arthur Morris gets arrested. You've got a list and say, we're prepared to change our view immediately. We're flexible, we're nimble, we can do it. And it applies to equity investment, it applies to all our classes. And that's what we've done over time. It's worked for our clients. But one of the points to just make, it's part of our process and philosophy. We have a process that does it. That's Rezco value trend funds, a red line. That's a couple of great large peers. It's not part of their process. It's not, we prefer to say, he has a difficulty. Let's just sit on our hands a little bit, see how it plays out. Funnily enough, this is obviously the time history is not as long here. This was a couple of mid-sized managers, good funds, but you can see even there, where size is not an impediment, it's also not part of the process to actually flex the asset allocation. It's got to be something that's part of your risk management process, and I think we do that pretty well. And we see it as this wheel. You can rotate between these classes. You don't have to have a static asset allocation to local equity, global equity. But you've got to be managed. It's got to be part of the way of your thinking. It's not just, otherwise you're going to get whipsawed on it. And so this is how the building blocks have come together over time on it. The red there is local equity. The local fixed income is the blue. Light blue is the foreign fixed income, and you can see it all. You get these pieces from different places. The line chart is the peer group, so you can see our bar stack generally causes us to outperform. But you're getting this when something isn't working, something else is working. So the funds today about 14% versus the average CISA high equity is about 2%. But you can just consistently rotate when equities are really, really working. Like you can see that period 2012, 13, local equity and foreign equity was brilliant. It was great to be there. At the moment, that hasn't been working, and we've got to work hard to go and try and find it. But just coming back to his important point I just wanted to make, this slide which we had up earlier. So that's the longer, the 3-year performance of value trend has done well, performing out relative to the peers. But we did that webinar in June. We said we're pretty uninvested. We're worried about some of the risks out there. But what's happened over that period? You can see we're fairly uninvested. That's zooming in for just 3 months, fairly low asset levels. But we haven't just done nothing. We've been working hard with your money, with our clients' money, because you see the relative to peers over the last quarter, value trend is in the top decile, which is very important. It's not, so we performed well last year, found the opportunities. We performed through the Corona crash, and then we've actually through this, even though it's where you take your risks that's important. So as much as we're saying, look, guys, we last webinar, the guys, there's a lot of danger, and there still is a lot of danger out there, but we selectively can take the risks. You can get this picture. Even we're positioned for a very risky environment, the fund is still top decile over the last quarter. It's very important. It's working. We're working hard to try to do that for our clients.
So Rob, just to jump in there, just important to emphasize, we're very cautious around protecting our client capital. It's so important in these risky times that if something goes really wrong, we've still got the capital to grow in the future, right? So really important to note, yes, we did nicely. We got kind of 4% for the quarter, and we beat peers. Everything kind of worked out well for this last quarter. COVID risk dropped, the fatality rate, things started opening up. You had a lot of stimulus, equity markets globally rallied. Everything kind of the vaccines keeping on chugging along. They got new treatments for COVID. There's increased confidence globally. People are getting out again. So everything it was pretty much a good case scenario. It wasn't guaranteed 3 months ago, 6 months ago, that we're going to recover the way that globally I'm talking, we're going to recover the way that we have. Had the market crashed again, i.e. it had a bear market rally and it crashed again, we were actually positioned for that outcome, while noting to take select opportunities to get some good returns. So had the market crashed, Rezco value trend would have been a significant outperformer in a market that fell a lot. That being said, it didn't, and we're flexible, we're nimble, and we managed to get some good returns for our clients, despite the fact that we're so cautiously positioned, because you don't have to take risk with half your portfolio. So we've only invested 20% roughly in equities through the last 3 months, and that's enough to get a good return. You don't have to invest 60, 70% of your client's money in a very uncertain environment in order to get returns.
Yeah, so that leaves you with a nice Sortino ratio. Being technical, it's a good measure of risk. Sortino measures up. Basically, it doesn't penalize you for upside volatility because you want to do better than competing funds. Funds got a great Sortino ratio and a fairly low correlation. So you're different to the peers. This is the 3-month period, Q3, with top in the class Sortino ratio. And just to leave it you with this one, there's our 15-year track record, 477% outperformance. But the blocks actually perform a lot during bull market. We love a bull market. Bull markets are great. It makes our life a lot easier. Outperformed in the bear markets, but the periods when the market goes up, we're not doomsday investors. We're happy to wait. If we find where there's a nice bull market, we probably do even better. We're not just always cautious, nervous investors. Thank you. I think we've still got a bit of time for some questions. Thanks very much for being on. I'll obviously still be answering the questions, and I'll let Simon phrase him.
Great. So I've got a few questions here to answer. Obviously, you can keep putting your questions in there, and we can keep going for a little bit. So just an important question on in this environment, low return environments. Howard Mills is just asking about our view on local and international property. Now, Howard, we were cautious on property before COVID. In South Africa, overbuild, weak economy, structural changes, over-indebted property companies. Accounting wasn't great, cash flow just wasn't there. So we're cautious pre-COVID. COVID just makes it worse. We're thinking value trap when it comes to local property. There's still a cleaning out of the industry to reduce that kind of overcapacity and to right-size kind of the balance sheet debt levels and so forth. So we're still very cautious on local property. Similarly, international property have some similar problems, especially priced against very low interest rates in developed countries means that you're reliant on interest rates staying very low within your valuation, which adds some risk. So we're cautious on international property, but I wouldn't call it a value trap. But local property, I'd say, still sits within the value trap space. It's fallen a lot, but equity holders of a property company are the last to get their share of a very indebted structure. So you've got to remember that equity can lose all its money. You can always, the funny things about share prices falling, if a share falls 50%, it can still fall 75% after that. You can always lose money in equities, as we've been learning in South Africa over the last number of years. And then we've got a couple of questions as well on bonds. Dean asking, please share Rezco's take on South Africa's default and credit risk. And so Dean, importantly, default risk for South African bonds is low. South Africa can print currency, right? So when you borrow in rands, your default risk is low. Your real risk is inflation risk and currency risk if you're a foreigner. That's what you've got to be careful of. We take a fairly absolute view when it comes to risk. We don't ever like losing money. And so while you might get your rands back, if your rands are worth less, it's not technically a default, but you lose spending power. And so that's the real risk of South African government bonds. If the country doesn't really get to grips with things, you could get inflation, which makes your bonds worth less. You can lose capital value in rands as yields can go up. Your bond price goes down, and so you can lose capital value in bonds. But as far as default risk goes, that specific risk, i.e. if you hold it to maturity, that risk we don't see as too high. That being said, I don't think any of your clients would be happy if we bought 10-year government bonds and said, just wait 10 years and we'll give you your money back. I don't think anyone's going to wait that long to get their capital back in this context.
Yeah,
it's the
drawdown risk as well. If I can just chip in on that, your risk of volatility is quite high. So a 10-year bond, they're probably not going to default. But 10 years is a long time. Things can go wrong. But you get your, they've got to get 600 billion rands worth of issuance away this year, and for 50 next year foreigners keep on selling, it might be tricky. So what happens is bond yields go up. So the 10-year goes up 2%, you've got a problem. And your volatility is not great, particularly a client who's got a draw, who's drawing out of that portfolio. If you tell a client, fine, don't draw a cent for 10 years, you've got an argument. But clients who are drawing out, it isn't your returns that become a problem because you're crystallizing those losses. And if you do the maths on it, it's pretty nasty experience for the clients to do that. So we've still got a little bit of time on some questions. So
yeah,
if we're going to go a little bit over, we're happy to keep rolling, stay on the call. And those who have to leave now, really thank you for being here. So we'll just roll in through a couple more questions that Simon's got there.
Great. So a question on performance fees. I think that's important. Obviously the Rezco funds, this is from Carl. So obviously the funds have done well, and so there have been performance fees within the performance fee classes. Are new investors paying fees for past performance? So how do our performance fees work? I think that's an important question because we very much like to align ourselves with our clients' interests. And so we have designed our performance fee to be as fair as possible. I should probably let Brian run through the performance fee.
I'll pick that one up.
You want to pick that one? Okay, you want to grab it.
The camera's on me. No,
okay.
So the size of the fund that the performance fee is based on is a 12-month moving average of the size of the fund. So if, say the fund doubles tomorrow and the performance fee, the next day, there's performance fee that's kicking in, that's not going to pay performance fee because the moving average won't have changed much. But we penalize ourselves further if we lose assets. Time to time as an asset manager, you get an outflow, then we use the lower of. If it's going down, we use the lower, a lower bound, so it's actual assets. If we're getting inflows, it's a 12-month moving average of our assets. Obviously, at the moment, we are getting inflows into our funds, but it takes a long time, and it's probably the best mix of when you actually pay the performance fee.
Great. And obviously, Carl, if there's any more follow-up questions, we're happy to run through the exact maths and the formula. Just give Brian or someone a shout. We're happy to talk about fees. We want to be pretty transparent on them. So question from Cornet. How does Rezco see the 5-year growth for SA Inc. versus global? Cornet, it's a good question because a lot of people are asking this question saying, well, there's a lot of noise, there's a lot of volatility at the moment. You know, we're taught and we're schooled to be long-term, careful investors, stick to the plan, the value eventually emerges. Where I'd hesitate with that, and of course, a lot of us have been schooled in that thinking, where I'd say there's a risk to that mindset is when you have domestic, so in this case, you're asking about SA Inc., when you have risk factors that are geopolitical or economic, taking that long-term mindset can add risk. I.e., we've got to go through an election, we've got to go through quite a lot to get to year 5. And so to blindly stick with something in a country like South Africa, we're a small emerging market that no one really cares about globally, to be honest. We've got to put ourselves in context. I love South Africa, I live here. But what I'm saying, in the context of the investing world, no one cares about us. We're a risk on, risk off. We're an emerging market. And if investors don't like the risk, they got no reason to buy South Africa. They got Brazil, they got Russia, they got Turkey, China. They got anywhere in the world to invest in. We need to win funds, and we need to win globally. So this idea of taking a 5-year view on SA Inc., I think takes a lot of time risk, given that we're in a very precarious economic and political situation. I'd argue that it's better to take a flexible and nimble approach. As new facts emerge, adjust quickly, as opposed to taking Yeah, carry on.
If I could weigh in there, that graph that we had up earlier with the various trajectories of our debt to GDP. There's the red line, which was quite high, and then there's a white line, which is a bit lower. Now, that's Minister Mbowene's graphs, and his own opinion on the red line is if we just go on that line, we've got a sovereign debt crisis in about 3 years' time. Is he just being the doctor giving you the truth, or is he just trying to scare the children? Probably a bit of both. But that's what you've got to ask. You've got to be prepared for either of those scenarios. Is it the white line, strong fiscal discipline, getting government spending on salaries and wages down, or is it just the business as usual, government inaction, red line, which your own Dr. Mboweni says, look, guys, you go that route, you're going to have a heart attack. And that's what we would be nimble assessing, which path are we on? And
So,
Plus SA Inc. share is going to have a big impact.
Exactly. So Corné followed that up with another question I picked up here. Thanks, Corné. Specifically within the retirement space. So you're already taking a long-term view because you're in the retirement space. Okay. Should we reduce the SA Inc. exposure for the short term? Now, this is an interesting question because, and hopefully I'm not going too nuanced here. Should we refers to the financial advisor? Should we reduce the SA Inc. exposure for the short term? We as Rezco, we take that decision very seriously. We take active asset allocation. We take that flexibility very seriously within our funds. And we think we're in a very good position to make that decision and to adjust quickly when the facts change, when there's new information available, or when there's big changes, whether it's political or economic. It's very difficult as a financial advisor to be moving SA Inc. exposure around. It's quite tricky to do that. There's leads and lags, timing wise. You could be managing a portfolio of funds and so forth. We think a flexible fund is like value trend, is a very good way to move between SA Inc. and global, because you've got that mandate that allows you to do that. And of course, SA within the South African space, SA Inc. or cash is a very important question, because you don't have to invest in anything in a Reg 28 fund. It's only got maximum limits. It doesn't have minimum limits. You can invest in zero SA Inc. and a large allocation to cash. So we're very cautious on SA Inc. Corné. So yes, at the moment, Rezco has a very low exposure to SA Inc. If I had a high exposure, we'd be reducing it. But we don't. We always try and match. That's why, Robert, that slide up of time to implement decisions. One of the things about Rezco is when we do a presentation like this, if you pull up our fund fact sheet, obviously an up-to-date fact sheet of our allocation, it's going to look like what we sound like in this presentation, because there's a very short time to implement. So our view is to be cautious on SA Inc. and the funds have low exposure to SA Inc. It lines up perfectly. If we change that view, we'll increase the exposure. Me personally, that's our view, so it's obvious. That's what I'd recommend, but I can't give advice on individual clients, because as you know, they're unique and they all have different exposures and so forth. Okay, we've still got some more questions coming in. We're happy. This is like our little coffee break after the presentation to chat to everyone outside while eating a Sami. Unfortunately, there's no Samis. We're available, but obviously if you do need to go, we understand. But we are still getting new questions coming through, so happy to answer them.
Yeah, we'll roll a little bit longer. Just the one thing, Brian, we'll be sending the CPD certificates. We'll put a link through to the presentation. I was stealing a bit of Brian's thunder, but I'm on screen, so I'll do it. And yeah, if you're going, just really appreciate you being here. It's been fantastic to have our clients, friends, and hopefully new clients on with us here. And please get hold of us as well. But we'll carry on answering a couple of questions for another 5-10 minutes. There seem a big queue of questions. If there's some interest, please stay on. We'd love to just, Simon said, normal presentation, we can stand around afterwards and chat and talk. So we'll try getting back to the normal world and run it for maybe another 5-10 minutes. But thank you for being here. If you need to go, we understand you. Everyone's quite busy in this environment. So Simon, the questions.
Great, yeah. So Troy Donaldson's got a question. And it's a tough one. It comes up all the time. So I'm sure he's just looking for our updated view, not for our philosophy around it. Due to the volatility of the currency, it's a big part of his clients' portfolios, everyone's portfolios. Obviously, since the COVID crash, the rand went from 19 to 17, but even stronger now. When is the appropriate time level to deploy capital offshore? So Troy, that's kind of the age-old question with South African advisors. It's very, very difficult to time it. What we usually think about it is you got to be very careful about tail risk. So previous presentations, sure, if you've been on them, grey rhinos and so forth. South Africa is an emerging market. We're small and we're volatile. And we'll take our cues normally from the rest of the world, whether the rest of the world is risk on or risk off. That's what drives the rand most of the time. The reason the rand went from 19 to 16.5, maybe there's a small bit of positive political news, but it's largely because all the other emerging market currencies strengthened, because we were in a risk-on environment. And so my caution around currency and client portfolios is to say that you've got to put South Africa in a global context. It's very easy living here to think about South Africa and make rand decisions based on our local politics and economy. That being said, as I said, reference grey rhinos. That's these low probability, high impact events. I'm sure in our previous presentations, you've heard us talk about that. South Africa is exposed to the grey rhino, the negative event of things going wrong. And that's why we usually, as a risk management, would have a fairly large exposure to global currency or equities and so forth. It makes sense from a risk management, but it doesn't always make sense from a return, chasing a return, like trying to, buy dollars at 17 and sell them at 19 and do that twice. We don't think playing the currency in the short term is necessarily a good decision.
Yeah, having said that, at 1950, we were bringing money back. We pushed more offshore at 1650. So if you got money, you were sitting with your finger on the button, looking for a time to go. 1650 is not a bad price. You might want to wait around 15. I think it's more on balance. If we had extra cash to be putting offshore, we'd be doing it probably here. But there's a lot of moving parts. We think the kind of bear market carries on, becomes a bit risk off. So your risk weighting probabilities is 1650 is probably not a bad level to increase your offshore if you were about to do it anyway as part of your strategy.
So nice question, a kind question. From an anonymous attendee, some of the underperforming other South African balanced funds have grown by between 15 and 20% over the past 6 months. Is it time to take some profits? And obviously here, we're talking about the big V shape in unit price returns. So the last 6 months captures the recovery after a crash. It feels like a get out of jail free card in South Africa. In my personal opinion, the economy is really in a tough spot. I'm surprised and I'm glad that client portfolios have recovered so well. I personally didn't expect it. You get bear market rallies and so forth. It's quite normal to have that volatility, but I'm surprised at how well client portfolios have recovered despite the macro. Is it time to take profit and reduce risk? We are not taking a lot of risk. So I'd have to make it clear that the Rezco funds think it's not a good time to take a lot of risk in this environment. If I was down 30% and I got it all back, it'd be like a little bit like being at the casino where my money halved. As I got it back, I'd say, you know what, actually, let's just go get an ice cream because it's time to walk away from the table. It feels a little bit like the market's just been propped up by stimulus and free cash. You can see last night, if the US economy needs a few trillion just to keep going, a few $1 trillion, these are ridiculously large numbers. I mean, when you talk about stimulus of between 1 and 3.5 trillion, whether you're a Republican or a Democrat, if that's what you need just to keep the patient alive, what happens when you take it away? And you can see how the markets reacted last night. I think there's the negative risk to the downside in this market. If I was invested fully in equities, it's obvious what I'd be doing because the funds don't have a lot of risk at the moment. The Rezco funds don't have a lot of risk. That being said, it's also a good time to reconsider rebalancing client portfolios. You might have a fund there that you're not happy with or whatever. It's up to you. I'm not going to give advice here, but given how the recovery has unfolded, if you do need to do some rebalancing, you talk about taking profits. Of course, that means maybe investing elsewhere. It's not a bad time to do that given the strength of this kind of V shape in equity markets. I don't know, Rob, if you want to add to that or.
Yeah, we think it comes an asset allocation thing, and we think the asset managers, that's our job. We feel that job has been given to us to work out which classes to be in, and worrying about it on your behalf. So we know if I take a holiday in December, I'm looking at the market every single day. We're working, we're thinking, and it's time, when do you deploy the cash? So I would agree with Simon's thing. I think you've got a bit of a get out of jail card. It's not the start, a bit out of jail free card. It's not the start of a great bull market. There's a lot of the risks are big risks to the downside here, not big risks to the upside. The upside's fairly small, the downside big. And we think that job, we obviously try to do it and we've got a good record of doing that particularly well. We should be worrying about it on your behalf, on your client's behalf, rather than, because these markets are nuanced. A couple of things can change, and it can change where you invested. You've got to be flexible. You've got to be nimble. The market in March at the bottom was too cheap to sell any fund or do anything. I don't think that applies anymore. I think it's a good place to do your research and put your money with who you feel is going to get a great return for your clients going forward. And let us, while you're on holiday in December in Plett, let us be worrying about it and worrying about the client, because that's what should be our job. I think it's an easy cop-out for asset managers to let someone else worry about that. But asset managers are trained. We've got 30 years plus in the market. It's our job. If we're not able to do that, and it isn't just the old world of static asset allocation. Everything mean reverts. I do nothing. We don't think that really helps. It's not what you've got to do for your clients.
Great. So we're almost kind of wrapping up with the questions here. Howard Mills has got another question, just asking on the offshore side. I think it's important. I don't think we've spent that much time on it. So are you investing in good value offshore shares? And what is your view on where the currency is at the time? So we've spoken a bit about the currency, but I think the question that I'd like to emphasize there is, are we finding good value offshore shares? Now, very important, what causes market bubbles and crashes? One of the big things is this idea about relative valuations. So this idea, there's a lot of, say, let's just take the US, for example. There's some shares that are directly impacted. Banks, airlines, suppliers to Boeing, those kinds of shares are clearly impacted, and the share prices have fallen and valuations have fallen. Are these good value opportunities? And then there's some shares that have recovered. They're not necessarily, they were big techie shares, but they've recovered to pre-COVID levels. And then, of course, you've got your tech winners that have doubled or tripled since the start of the year. Okay. Now, the points I want to make, because I obviously can't go through everything here. The points I want to make, what's dangerous in investing is to be sucked into relative valuations. Okay, I'm not going to buy something that's tripled. Zoom. Okay, we're on Zoom now. It's a great product. Okay, I'm not going to buy something that's tripled, but check this share that's only back to pre-COVID levels. This must be good value because I can buy it at the same price that it was a year ago, kind of a thing. You got to be careful. There's a tough economy. Some shares should be down. The economy's in a really tough spot in the US. It's being propped up by free cash and helicopter money and low interest rates and quantitative easing, but it's in a tough spot. And relative value is a dangerous game. And so we think more valuations, a little bit more absolute, a little bit more through the cycle than just to say shares that maybe have fallen and haven't gone up as much as the favorite tech shares versus the growth shares. So we're not seeing a lot of good value offshore. We're seeing some good relative value, but we're not seeing a lot of good absolute value, where in our terms, value is growth at a reasonable price. Growth that's got a good valuation, right? A good quality business that's not too expensive. I could say three ways, but so that's what we're looking for. We're not finding a lot of that, although we are finding some specific stock picks, specifically within the resources space and some kind of the more under-researched space. We're finding some opportunities, and we have been taking some opportunities, and you can see it in the fund returns that we're ticking up a bit. So obviously we have found some good opportunities to grow client money, but I wouldn't say that there's this huge list of great shares that we're just itching to buy or own globally. Okay, and the last question that I want to answer, it came anonymously. sorry, we still got over 100 people online at the moment, so I think it's worth still answering the questions. We spoke a bit about fixed income, and this attendee popped their question up at the time. Why will the search for yield by foreign investors not stimulate purchasing of our bonds and a higher yield, our bonds with a higher yield than that of Europe and US? So very importantly, South Africans' yield on our bonds is significantly higher, call it somewhere between 5 and 7% versus developed markets. Maybe even slightly higher than that. And it's even significantly higher, I would say, or I'd add to that question, than other emerging markets. So our bond yields in South Africa are attractive relative to a Brazil, a Russia, and so forth. So we're attractive on both levels. And why would foreigners not just come piling in? Okay, well, firstly, they're not. So we know that for sure because we've got the data. Foreigners are selling. Now, why are foreigners selling? Remember earlier I said that the default risk is low in rands, but foreigners' return is not measured in rands. Their return is measured in dollars. And so why are foreigners not piling in? Well, they have to be very cognizant of the risk of getting their money back in dollars. Even though they're lending South Africa rands, they need money back in dollars, i.e. they've got to convert it. They can't leave the currency or the investment in South Africa. At some point, they've got to convert it back to dollars and lock in a profit. And so the political and the economic considerations for a foreigner, the emphasis differs. And in this situation, South Africa needs to show some kind of consistency in an improving expectations going forward politically and economically. And where we're currently sitting, as per our Minister Tito Mbowene's charts, if we don't fix the economy, it breaks. So your choices are extreme. Do you want to lend to a failed state? What's your probability on that scenario? Or do you think South Africa is going to fix its problems? If you think South Africa is going to fix its problems, we are a good investment. The problem is the risk if we don't. And that's the risk that the foreigners are worried about. And they don't just get to hold to maturity in rands and say, well, it doesn't matter if we just keep our money in South Africa until the year 2030, we will be fine in rands. We'll get our money back. That's not a consideration that's even on the radar for a foreign investor. So we need that certainty to, or that confidence to come back by foreigners until we see that, that gap close. And hopefully we're seeing the start of it, but I'm not sure. And I think let's wrap it up there. One or two questions, but we've broadly spoken about them that are left unanswered, but I think we've covered most of the questions. It's back over to you, Rob.
So Rob, Simon, thank you so much. That was very insightful. We really appreciate your time. And more importantly, thank you to you, the advisor and the client, for your time. I know there's a lot of webinars taking place and everyone's sort of screaming for some of your attention. We do appreciate the questions. As Simon said, if there are ones that we haven't answered or you think of some later on, please email me, Brian at Rezco, or info@Rezco, and we'll be sure to get back to them. As Rob said as well, we will be sending out a link to the CPD certificates and a link to a full copy of this presentation or recording of this presentation and the slide deck. Once again, thank you for your support. Thank you for your time. And with that, we'll end the webinar.